Welcome to this explainer where we're going to unpack Stifel's massive second quarter 2026 financial results. Look, generating consistent, record-breaking growth in today's incredibly complex market is absolutely no small feat. Yet Stifel just posted a quarter that demands our full attention. We're going to break down the strategies, the segments, and the operational shifts that made this happen, sticking strictly to the data from their latest earnings presentation.
Okay, let's just dive right in. This statue right here, aptly named Forces, sits smack at the heart of Stifel's corporate identity. And you know, it's really the perfect visual metaphor for the constant push and pull of the financial markets, that classic battle of the bulls and bears. But, as you'll see in the data we're about to cover, for Stifel, the bulls were very clearly running the show during the second quarter.
So here is our game plan for today. 1. Record second quarter results. 2. Beating analyst expectations. 3. Segment performance breakdown. 4. Culture, AI, and efficiency. And finally, 5. Deploying excess capital.
All right, jumping into Section 1, record second quarter results.
Let's start right at the top with the big reveal that immediately grabbed Wall Street's attention. Whenever a financial firm throws around the word record multiple times in a single earnings snapshot, you definitely pay attention. Stifel reported a staggering non-GAAP net revenue of $1.453 billion. I mean, they didn't just inch past their previous benchmarks, they surged. But we all know that in the financial sector, top-line revenue is really only half the story. It's all about how effectively you can drive that top line down into actual profitability.
And that top-line number brilliantly translated directly to the bottom line, delivering a non-GAAP earnings per share of $1.42. For shareholders, this is the magic number, right? It means that record-breaking revenue wasn't just, empty volume. It was highly profitable business that actually delivered $229 million in non-GAAP net income available to common shareholders. They expanded their operations incredibly efficiently, turning billions in revenue into very real, very tangible earnings per share.
Moving on to Section 2, beating analyst expectations.
The truest test of a company's momentum is whether it can outpace Wall Street's collective expectations. And Stifel cleanly beat the consensus across the board here. While the 2% beat on net revenues is definitely solid, look specifically at investment banking. Analysts were expecting $309 million. Stifel delivered $332 million. That is a massive 7% variance. And that flowed straight down to diluted operating EPS, which also came in 7% higher than anticipated, at $142 versus the expected $133. Beating expectations this cleanly, especially in high-margin areas, really signals that their internal engines are running significantly hotter than the broader market even realized.
All right, Section 3, segment performance breakdown.
So what exactly is driving this outperformance? To understand that, we need to look under the hood. Looking at this revenue bridge from Q2 2025 to Q2 2026, we see a massive jump from $1.284 billion up to that record $1.453 billion. This upward momentum was driven heavily by underwriting and client facilitation, which both added $68 million in growth, alongside some really solid bumps from advisory and net interest income. So this isn't just one lucky trade paying off. This is broad-based, multi-segment growth.
But honestly, if we are looking for the primary heavy lifter here, it was undoubtedly Global Wealth Management. This division hauled in a record $957 million, which represents a 13% year-over-year increase. This was heavily fueled by transactional growth, which jumped 14%. And perhaps the most impressive metric of all, they drove total client assets up 12% to over $580 billion. Let that sink in. They are not just making more money on existing assets, they are aggressively acquiring and growing the actual pie of wealth they manage.
And hey, not to be outdone, the institutional group delivered an absolute masterclass this quarter as well. Revenue jumped 15% year-over-year to $481 million. But the real standout statistic, a staggering 121% year-over-year surge in equity capital raising, literally more than doubling it. Plus, they captured the #1 rank in municipal issuance year-to-date with a 14% market share. So they aren't just riding a broader market wave, they are out there actively stealing market share from competitors.
Which brings us nicely to Section 4, culture, AI, and efficiency.
Exceptional external numbers, like the ones we just looked at, require exceptional internal catalysts. You simply can't sustain this kind of growth just by pushing people harder. You have to work smarter. Stifel utilizes a dual-engine approach to that exact challenge. On the human side, they just ranked #1 in J.D. Power employee advisor satisfaction for the 4th consecutive year, meaning they're retaining top talent because their advisors actually feel supported. On the tech side, they are deeply integrating artificial intelligence, effectively marrying an award-winning culture with cutting-edge data technology.
By keeping employees at the very center of the client relationship, Stifel is using AI not to replace their award-winning advisors, but to empower them. They're using it to dramatically increase access to data, to reduce the time it takes to prepare analysis, and to vastly improve back-office efficiencies. And this translates directly to increased client engagement. Think about it. When your advisors aren't bogged down in administrative busywork, they have more time to actually advise, which is exactly why those client asset numbers we saw earlier are growing so rapidly.
And finally, Section 5, Deploying Excess Capital. All of this operational efficiency ultimately leads to the most important part, how Stifel actually rewards its shareholders. Management here is playing both defense and offense brilliantly. On defense, they are ensuring absolute stability with a strong 11% compound annual growth rate in bank funding since 2021. On offense, though, they are aggressively taking excess capital and repurchasing 2.4 million common shares right in the open market. This reduces the overall share count, mathematically making your remaining shares more valuable, and it sends a massive signal of internal confidence in their ongoing valuation. Furthermore, we're seeing strong foundational growth across the entire balance sheet. Total assets are up by $2 billion. Loan growth jumped by $2.6 billion, signaling a very healthy, active, and functioning balance sheet that is out there working and generating yield. And just in case you were wondering if the buybacks were over, they still have 7.8 million shares remaining in their total authorization, so management has plenty of ammunition left to continue supporting the stock price.
So, as we wrap up this explainer, I want to leave you with this final thought. We've seen the record revenues, the 121% surge in equity capital raising, the strategic AI integration, and those aggressive share buybacks. It all culminated in a non-GAAP return on tangible common equity, or ROTCE, of 23.6%. In the financial sector, that is a phenomenal benchmark of sheer profitability. The big question now becomes, is Stifel's unique blend of having the industry's happiest advisors paired with relentless AI efficiency the ultimate blueprint for sustaining this outperformance into Q3 and beyond? Well, based on the data we just walked through, the bulls certainly seem to think so. Thanks for joining me on this explainer, and keep learning.